studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
Club dues and recreational membership fees are another common Schedule 1 adjustment. But unlike meals and entertainment, the rule is even simpler. For accounting purposes, the corporation records the full cost of the membership as an expense. For example, if the company pays $3,000 for a golf club membership, the entire $3,000 is recorded in the accounting records and reduces the company's accounting income. However, the tax treatment is completely different. In most cases, membership dues paid to recreational clubs are not deductible for income tax purposes. This includes organizations such as golf clubs, country clubs, tennis clubs, yacht clubs, and other clubs whose primary purpose is recreation, dining, or leisure. As a result, the corporation cannot claim any tax deduction for these membership fees. Using our example, although the accounting records show a $3,000 expense, the allowable tax deduction is zero. This means the entire $3,000 must be added back on Schedule 1 when calculating taxable income. Notice the difference between this adjustment and the meals and entertainment rule. With meals and entertainment, only 50% of the expense is added back. With recreational club dues, the adjustment is generally 100%. None of the membership fee is deductible for income tax purposes. A simple way to remember this rule is to separate the accounting treatment from the tax treatment. The accounting records recognize the full expense because it was paid by the business. The tax rules, however, deny the deduction entirely, requiring the full amount to be added back on Schedule 1. Whenever you see expenses for golf clubs, country clubs, tennis clubs, yacht clubs, or similar recreational memberships, they should immediately remind you to review whether a 100% add-back is required. This is one of the easiest Schedule 1 adjustments to remember. Record 100% in the accounting records, deduct zero for tax purposes, and add back 100% on Schedule 1. Not every membership fee is treated the same for tax purposes. One of the most important skills for a tax preparer is knowing the difference between recreational club memberships and professional or business-related memberships. Let's start with recreational clubs. Membership dues paid to organizations whose primary purpose is recreation, leisure, or social activities are generally not deductible for income tax purposes. Common examples include golf clubs, country clubs, tennis clubs, yacht clubs, riding clubs, and other private recreational facilities. Even if the business owner occasionally discusses business with clients at these locations, the membership fee itself is generally not deductible. As a result, the entire amount is added back on Schedule 1. On the other hand, not all memberships fall into this category. Organizations such as chambers of commerce, professional associations, industry organizations, and certain business networking groups may have a different tax treatment because their primary purpose is to support business activities or professional development rather than recreation. These memberships should be reviewed separately based on their specific purpose and the applicable tax rules. They should not automatically be treated the same as recreational club dues. A simple decision process can help. Ask yourself one question first. Is the organization's primary purpose recreation or leisure? If the answer is yes, the membership is generally not deductible, and the full amount should be added back on Schedule 1. If the answer is no, don't assume it's deductible or non-deductible. Instead, review the nature of the organization and apply the appropriate tax rules. One of the most common mistakes beginners make is confusing professional memberships with recreational club memberships. Although both involve annual dues, they are governed by different tax rules. So whenever you review a membership expense, don't focus only on its name. Focus on the organization's primary purpose. If it's mainly recreational, think 100% add back. If it's primarily a professional or business organization, review it separately before deciding on the correct tax treatment. As a tax preparer, reviewing club dues is usually a straightforward process once you follow a consistent workflow. Start by reviewing the general ledger and identifying any expenses related to club memberships, recreational fees, or annual membership dues. These accounts are often named club dues, membership fees, or something similar. When you find a membership expense, ask yourself a few simple questions. First, is the membership primarily for recreation or social activities? If the answer is yes, that's your first indication that the expense is likely not deductible for income tax purposes. Next, consider who benefits from the membership. Is it intended for personal recreation, client entertainment at a recreational facility, or general leisure activities? If so, the expense will usually require a 100% add back on Schedule 1. Then ask whether the organization is actually a professional or business organization instead of a recreational club. Professional memberships and business associations may follow different tax rules and should be reviewed separately before making a decision. Also confirm that the expense has been recorded correctly in the accounting records. Even though the membership is generally not deductible for tax purposes, it should still be recorded as a business expense in the accounting records before being adjusted on Schedule 1. As you review the accounts, watch for common red flags. Golf club memberships, country clubs, tennis clubs, yacht clubs, luxury recreation clubs, and executive social memberships should immediately attract your attention because these are among the most common expenses that require a full add back. The most important thing to remember is this simple rule. If the membership is primarily for recreation, leisure, or social activities, assume it is not deductible for income tax purposes, unless another specific tax rule clearly says otherwise. The accounting records will still recognize the expense, but for tax purposes, the entire amount is generally added back on Schedule 1. Following this simple review process will help you identify non-deductible club dues quickly, avoid common errors, and ensure that the corporation's taxable income is calculated correctly.